And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Wednesday. It is Hump Day. We are halfway through the week. Thank goodness. It's already been a week already. Anyway, Danny Ratliff joining me this morning. Got a few things to get into. Of course, if you live in Texas, we're being flooded right now. So just be careful if you're listening to the radio this morning, driving around. Be careful. Streets are wet, and there is some puddling going on. So again, you know, it was interesting because last week we're talking about it being below freezing here, and now it's like in the 70s and we're flooding. So, hey, if you don't like the weather in Texas, hang around a minute. So it changes quickly. Anyway, a couple of things. Yesterday, Netflix, after the bell, reported boomer subscriber growth, over 13 million new subscribers for Netflix. So again, they just kind of continue to really dominate the whole streaming space. And they're starting to prepare you for more rate hikes. So, it's very interesting. We've kind of touched on this on the show before, is that, there's so much competition in the streaming space now. Hulu, Netflix, Apple TV, on and on and on. And then, of course, on top of that, most of your now services, like if you want the Wall Street Journal, Bloomberg, etc., you have to subscribe to that. It's just, people are just being fed to death. And, it always amazes me when, people come out and like, hey, I have a new Substack, so come sign up for my Substack. I'm just curious where, and this is why we provide all our information for free, right? No subscription to our website. It's all free. But, it interests me that, where do you reach the point where people go, I've had enough, right? I've got all this stuff I just can't really afford to pay for. And of course, this has brought to light a whole bunch of new apps like Rocket App and others, where they'll actually just scan your monthly payments and cancel services for you that you want. This is going to be one of the interesting kind of models as we look forward for a lot of these companies. Is, how long what does it cost you to acquire a customer? How long do you actually keep them before they cut you off and go somewhere else? They may come back at some point, but the turnover of memberships is going to be very interesting to watch as we go forward. And again, and particularly in a time where more and more people are having trouble making ends meet. They're having to sacrifice things to, just live at this point. Just, the cost of living is exceeding the ability for them to stay up with it. And that's not just inflation. That is inflation, the cost of living. But it's also just all the other stuff that goes on that's happening. And, it's interesting. We've talked about the whole tipping issue right now, where you go to a restaurant and you walk up to the counter and you order your food and they prepare it, then you've got to walk back up to the counter and get your food, then go clean, bust your own table, and then as you're checking out, they go, how much tip would you like to leave? 15, 20, 25%. And I've noticed, before it used to cap at 20, now it's going to 22, 25. Though, pretty soon it'll be, you want to make 100% tip? So, it's just getting expensive, right? I mean, it's expensive to eat out, it's expensive with the tips, it's expensive with the services. And the question just becomes, at what point does, society just kind of buckle from literally being fed to death? I don't have the answer. It's just kind of a conundrum. But again, we talk about, we at one point it was all about cutting the cord and getting rid of the bundling. I don't think it's going to be long before we see the bundling coming back. People wanting to get a bundle of services at a cheaper price, to where they can get the channels and the streaming that they want, all bundled up for one price, just to make it easier and more convenient. So we'll see. I mean, I don't have, like I said, I don't have the answer, but we'll definitely see. But it is interesting. Netflix is doing very well. Stock is going to be up sharply this morning. It's also going to lift the entire NASDAQ again this morning. So guess what? As we talked about yesterday, it'll be a new high today. As markets continue to move higher, we have new highs every day. So it's certainly very bullish. outside of that, economically speaking, Richmond Fed Index came in much weaker than expected. That taps on to the Philly Fed Index, which is weaker. So again, as we still look at the manufacturing side of the economy, it's not doing that great. Services are doing okay, right? But the underlying economic data certainly isn't all that strong. But nonetheless, there's this, kind of this rush to get into the equity markets, and we're going to talk about that here in a second, but this rush to get into the equity markets, all on the hopes that the Fed is going to cut rates and increase liquidity. So speaking of markets, here's what you need to know before the bell. Let's go look at kind of around the market in some other areas. We've talked about the S&P lately and what it's doing. It's clearly on a buy signal, nothing going wrong there. Again, no reason not to be bullish. But I've been getting a lot of questions about bonds, right? Yields have been ticking up, and it was interesting as every day I get some emails like, why are yields up today? There was this piece of data that wasn't good, so why are yields up? Day-to-day movements in yields have nothing to do with anything other than just market dynamics. Over the long term, yields will reflect inflation, economic growth, wages, earnings, activity in the economy. That's where yields are driven. But day to day, that's noise. So don't pay attention to what happens from one day to the next. But we can look at yields. As we've talked about before, yields were very, very overbought. So again, yields are the inverse of bond prices. So for yields to be overbought, it looks like they're oversold on a regular stock chart, right? So this is actually, the bottom half, which is normally oversold for a stock, is overbought when it comes to yields. And that's what we're looking at here is yields, the 10-year Treasury yield. So got very, very overbought. We triggered a sell signal, and that sell signal has been in place. And since then, yields have risen right back to the 50-day moving average. We're challenging that 50-day moving average right now. And again, yields are going to look to be a little bit lower this morning. So we're continuing to just kind of wrestle with this. Have finally worked off that very overbought condition. We're getting now pretty oversold on yield. So again, we're getting pretty close to a buying opportunity to add to fixed income exposure. We're not there quite yet, but we are getting much closer. And again, yields could still move up here to say 4.25%, even 4.3%. Wouldn't be surprising, particularly if we get a fairly strong inflation print that might concern people that inflation's coming back near term. But again, the Fed is slated to cut rates this year. As the Fed starts cutting rates, yields will fall, right? Yields will track what the Fed's doing ultimately. So again, not anything really concerning here at all. And again, this is why we talked about taking some profits back when in November out of the long-dated treasuries. We did that. And so we're looking to put that money back to work here pretty soon. We're not quite there yet, but again, just something to do. Now, this is something that Michael Leibowitz will cover in great detail at this weekend's conference that we're going to have on Saturday. But moving on beyond that, we take a look at some other areas of the markets. While the S&P's been doing fantastic, of course, hitting new record highs, small mid caps have not really done nothing. Mid caps and small caps really pretty much remain very range bound here. This is the S&P 600, so this is the 600 small cap stock index. That really hasn't done anything going all the way back really to April of 22. So again, has traded sideways now for quite a while, but has done nothing. Same thing when we start to look at international markets as well. We keep hearing a lot about, you got to be in international because they're cheap relative to the domestic stocks. Remain deeply in a bear market, nothing going on in emerging markets at all. No reason to be invested there at the moment. Again, that continues to look weak. Developed international markets do fare a bit better, but again, continue to remain very range bound here, not making new highs. So again, when we take a look at the market, right, the S&P is making all-time highs, but even the breadth in the S&P remains fairly narrow to the big mega cap stocks. Same thing for the NASDAQ. So when you take a look at that, it seems like this overall bull market that we're having right now, this breakout to all-time highs, this exuberance, is a little bit sus, as my son would say, because, again, we're not getting the participation follow-up of other markets. That's what you need to know before the bell this morning. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome to the show this morning. Danny Ratliff joining me, who has been experiencing a life of havoc lately after his washer broke and flooded his house. How you doing, buddy?
I'm good. Good times.
Stuff like that happens. We talk about, we've talked about home ownership before. People, especially the media, is like, oh, everybody needs to buy a home. And of course, ever since 2000, we've done everything we can to get people into homes, right?
Yep.
With adjustable rate mortgages and subprime and you wonder why there's a housing problem, right? And housing costs are where they are. But what people always, what people don't factor into home ownership, and it's always, events like this, is all the other stuff that happens at homes. When we buy a house, we get anchored to that initial purchase, right? So I paid, $200,000 for this house and I sold it for $300,000, right? I made all this money on my house. I'm a genius. You forget about all the other stuff that happened in between, the maintenance, the upkeep, the repairs, a washer breaking and flooding your entire house.
Yeah. I keep telling myself it could always be worse, and it
of
really
course,
could,
of
right?
course. This is minor trouble, right?
It's
it
an inconvenience.
Far worse. Yes.
It's a pain in the rear. Things could always be much, much worse. And look, we're blessed; we have insurance.
Yeah.
But you're also,
But then you get the joy of dealing with insurance.
Oh man, it's very eye-opening when you go through something like this to see the actual cost of you. You start to understand why insurance is so high. Number one, the process is not
right.
very fluid.
And they don't
no
want
pun
to pay.
intended.
They don't want to pay out on claims.
Well, but they're like, well, we're going to pack all your stuff. We'll move you into a new place. And I'm like, I don't need that. I need this to be done right now. I want to get this done. And it's you go through. We're on our third adjuster, and adjuster number 2 kind of alludes like, oh, well, you already have. This is a 3 to 4 month process. I said, no, this is not. This is like a 3-week process. I've already got people lined up. We're ready to go. Just we're waiting on you. And oh, well. Was this planned? What do you mean was this planned? No. I've got life. I've got 3 kids. We're trying to move on here. I started making calls immediately.
Yeah.
So it's just a frustrating deal. And then you have to restart the process almost with each adjuster you have. I think we have a really good one right now, which we'll see. And because that will likely change as well. So
well, our heart goes out to you. It's always very It's very trying when these things happen. And look, we've been through too. My family, we went through, with Hurricane Harvey.
Yeah.
Our house got damaged and heavily, and the whole inside of our house was leaking, and we called the insurance adjuster out, and he looked at the roof, and we hear him up on the roof, like kicking the tiles. He's like, "Well, those tiles were flipped over before, before." And he was a shady adjuster. We had to go get another one. But it's a pain in the butt.
It is.
And
it's
so
okay,
I feel for you, my friend. I feel for you.
So I grew up in Houston where it flooded often, right? Yeah. I mean, like so much so that FEMA bought and tore down my childhood home. So, I mean, like, this is nothing compared to, the water and the things that we used to deal with where it was several feet high. I mean, this is no big deal.
That's what I kind of chuckle about, too, because I grew up in Lake Jackson, which is about an hour. If you don't know where that is, it's on the coast, on south of Houston. Our house was flooded 3 times with, different hurricanes that we lived through. And so I remember growing up, this is my childhood home. It's 1,100 square feet, two 3 bedrooms, 1.5 bath. I mean, very small, right? It's just a very small little house, normal for back then.
Yeah.
And, we had carpet when I was growing up. We had carpet in the house. And the first time we got flooded, my dad just ripped out all the carpet and tiled the entire house. And so when it flooded after that, he just would mop the house out. And that was it.
What's so funny, though, is that water's so different than like what we experienced with,
right.
water coming out of the washer, right? And the things we did back then, and we're probably paying for it health-wise. But, like I can remember there's one time that it flooded, and then it flooded again so quickly that we didn't even have time to do all the remediation. Right. And back then, the mold remediation was minimal compared to what it is today.
Well, no, when I was growing up, there was no such thing as mold remediation.
I don't think we did anything. You got the water out, you took some baseboards and some sheetrock out at best, and then you started over again.
Exactly.
I think a lot of people got to where they didn't even put insulation in a lot of places. They're like, forget it's going to happen again.
Exactly.
We'll deal with it.
Anyway, good times.
Yeah,
good
fun
times.
Stuff.
Living through hurricanes, it's awesome. Anyway, a couple of things to get into today. Again, as I noted, first of all, this weekend, Danny will be there as well as the Economic Summit. So it's just right around the corner. If you haven't got your tickets yet, I think there's a few left. Go by the website, click on the banner. Myself, I put my slide deck together. I finished it yesterday, talking all about market cycles, those type of things. Michael Leibowitz cover bonds. Greg Valliere talking about politics. And again, it clearly, after last night, Trump handily won New Hampshire, has now won Iowa as well. So it clearly looks like it's going to be a runoff, unless something just untoward happens between now and, probably the next couple of months. It's going to be Joe Biden versus Donald Trump in the next presidency. It looks pretty clear. And that's kind of what Greg Valliere is going to talk about in particular, is what does that look like in terms of the markets, the economy, policy, all those other things. He's very well spoken, very very educated in this area. Has been doing it for a long time. So it's going to be a really great morning that we're going to have. So certainly encourage you to come if you can. Just go by the website, realinvestmentadvice.com, get your ticket. Like I said, Danny will be there, Rich will be there. We all want to meet you. We'll spend a few minutes talking after the event. Anyway,
I'm interested though. We talked to Greg a little bit about what he was going to talk about, but I think things have changed quickly too. I mean, you think about this. Typically, when when somebody's running and they win Iowa and New Hampshire, the next
kind of foregone
everybody
conclusion.
else drops out. Nikki Haley's refusing to drop out.
Yeah, she's just stubborn.
Well, do you think she's waiting them out for bigger implications or something else that may happen?
There's always a shot that something. That's what I'm saying. Unless something kind of unexpected happens here, but her. If you look at the polls right now between Haley and Newsom, Biden and Trump, right? I mean, the spread there, it's like Newsom and Haley have like 5 and 7% on the predicting markets.
Yep.
And it's like 83% and 85% for Biden and Trump. So it's just a massive spread right now in terms of the predicted polls and those type of things. So, but yeah, I mean, Newsom's hanging in there too at this point. So, something could happen to Joe Biden between now and
somebody knows something we don't know. These guys like, we're going to wait them out.
Well, I mean, it is an age thing, so any day now.
Yeah, but I am interested to see what Greg says about that, because I think that's something that's changed since we, initially had all our conversations.
I'm really kind of hoping someday we elect somebody that's below the age of 50.
Well, and maybe somebody that's
or at least 60, maybe.
Like, there's so much out there. It's
That's a whole nother debate. Anyway, but that's coming up on Saturday, so it'll be very interesting. Yesterday, of course, as I said, Netflix reported earnings. It's going to be up about $48 this morning, so it's very sharp uptick with Netflix, and that's going to be driving the whole NASDAQ today. And again, we're into that earnings season part, right? So between now and next week, we'll be getting Apple, Microsoft, NVIDIA, et cetera. NVIDIA will be later. But we'll be getting all these big tech companies out. And just as a side note, if you had just invested, go back a decade, if you had just bought the NASDAQ, it has outpaced every other index by 2 to 1 or more. In some cases, 3 and 4 to 1. So it's been a pretty phenomenal decade. Of course, we talk about monetary liquidity, we talk about zero interest rates, we talk about all the other issues that go on. The deviation between NASDAQ and technology-driven stocks and every other index is it's interesting, because we talk about the S&P 500 every day. Very rarely do we talk about the NASDAQ, and we never benchmark our portfolios to the NASDAQ, thank goodness, because the differential in that performance is just amazingly enormous. It's just quite fascinating. So, but that's just that's going to kind of continue here for a while, because again, it's a function of what companies can grow earnings. And we talked a little bit about this yesterday. We talked about valuations. We talked about the deviation in the markets on the show yesterday. That article's on the website right now, by the way. But it is about where earnings growth can come from, and at this point of the cycle and where we are right now. If you take a look at where earnings estimates are for this year, the vast majority of the earnings growth itself is going to come from technology, a little bit from healthcare. Every other sector is not expected to grow earnings this year. So it's a pretty, bifurcated setup in the markets. And again, as we start talking about the markets themselves, and as I was showing you in the first segment, if you're watching our live stream, the gap between the S&P and the NASDAQ in terms of putting in new highs, and the Dow, I can't forget the Dow. The Dow's there too. But the Dow, the NASDAQ, and the S&P, yes, are ratcheting new highs. But if you take a look at small caps, mid caps, emerging markets, they're not even close to new highs. So, as we talk about markets, and as I kind of wrapped it up saying, this market's a little bit sus at the moment, as my son would say, because, you would think that if we're in a strongly trending bull market, the economy is growing, we're going to have this soft landing, lots of monetary policy, that we would see a very broad participation across markets. It wouldn't be nearly as narrow as it is. Now, I'm not making implications. I'm not saying that that's going to end. I mean, but you would expect that a rising tide is going to lift all boats, and so far we really haven't seen that be the case. To this juncture, it's been, and that's been making diversified portfolios, et cetera, much more difficult. Danny?
Well, I think that's interesting because we did see, we look back, I'll go back to October. Yep. The end of October, S&P, if you exclude those 7 companies, was down. Yep. And then we did see broader participation. We got to the beginning of the year, looked like we were going to continue to see that. And then it's just back to where we were.
Exactly. It's easy. It's easy money, easy out. All right, a couple of interesting things. One of Danny's favorite investments is the HSA, and there's a new bill out that may help taxpayers. We'll talk about that on the other side of the break, and the triple tax benefit, as he always says, the triple T's.
That's right.
Go back after the break.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Kids these days, they're always inventing something new. So have you heard about this new thing called Scrawlish? Scrawlish. It's a new way to write.
The Real Investment Show podcast.
So yeah, it uses a set of symbols to represent letters. And that way you can theoretically write faster, right? Take notes. It's very cool looking on paper and nobody can read it.
At realinvestmentadvice.com.
It's also called shorthand. We developed that like 50 years ago.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell Report, Financial Fitness Friday, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Danny Ratliff joining me as well. So there's a new piece of legislation being introduced by the Republicans in Congress to expand the use of health savings accounts. Danny talks about this quite often because, and he's going to tell you again, so just let me warn you now, that there's a triple tax benefit to HSAs, and it can save you a lot of money, and they're great. There's a couple of hitches to these, and the first, again, as he'll tell you, is that your company has to offer this as part of their plan, and this usually is tied to a high deductible insurance plan, et cetera. But more and more companies are starting to offer HSAs, and this new act that they're putting together is called the Simplify and Expand Health Savings Accounts Act, would actually be a pretty big boon for taxpayers. Danny?
Yeah, I think this is a really good option here. So number one, you hit the nail on the head. You do have to have a high deductible health plan. So what that means, if you're an individual, your deductible needs to be at least $1,600. If you have a family plan, it's $3,200 is your deductible. And so that's what constitutes these plans. Now, we have seen a lot of employers trying to pass the buck on to the employees. So we're seeing more and more of these high deductible plans. Not always do they offer the health savings account. So you can actually go out and purchase one on your own, go set up one of these accounts if your employer does not offer. But we are seeing these tied together because they're trying to kind of mask over hey, you've got to pay a lot more out of pocket for these plans. But we're going to give you the ability to use the HSA.
Yep.
So,
and if the company doesn't offer one, go ask them.
Yeah, you can certainly ask them, ask your benefits group, see if they can't set one up. There's really not a big cost to them. Now, some companies will offer additional incentives because they'll say, listen, if you will match your contributions to the HSA, we'll put in X amount, $500 every year to the HSA. And so this can be another way to collect more funds from your employer. So a great tool. So commonly, though, Lance, we do see this misused because we've had the flexible spending account for years where, if you don't use it, you lose it. Where the HSA, we would prefer people use this as a tool for putting funds aside, an accumulation asset here because you do get the triple tax benefit. So, we've talked about Roth for years, and now that seems to be really big on mainstream media. Financial media is talking about it, all over the place, right? We've got an issue where taxes may increase. So this is going to be another type feather in your cap in the sense that you put the funds in, they're going to go in tax-free. They grow tax-free. Assuming you use them for medical expenses, you're going to take them out tax-free. And so this is the only account in the world, like Lance mentioned, that does offer that triple tax benefit. So,
and real quick, just before you get too far down the road here, because you kind of flew by a very, very important point, and I've had a couple of people email me on this, is that the FSA and the HSA are very different.
Very different.
And so, just because if you go to your company and look it up, it's like, oh, we have an FSA. So I heard Danny talking about the HSA. So this must be kind of the same thing.
No.
They are not the same thing at all. And like Danny said, he kind of quickly blew by the point. The FSA is fine to have, but if you don't, the money you put in, if you don't use it by the end of the year, you lose it. I mean, it goes away. So that's not what you want. The HSA, the money goes in. You never have to use it. It can just accumulate there for a decade or 2 or 3 or however long you're living and working. And when you're in your retirement years, you can then start using your HSA for when you're going to need your health care most, in your last 10, 15 years of life. But that will be accumulating growth over time. So again, I just wanted to bring that up because it's very easy to get confused. It's just 3 letters. And don't assume that one is the same as the other.
Well, I think the easiest way to remember that, Lance, is that one is spending and one is saving.
Right.
But it is a very common mistake we see a lot of people make. And I understand not everybody can pay for medical expenses out of pocket. You may need to use this. That's what it's there for.
Right.
But ideally, if you can use this as a retirement tool, because we know the numbers. You look at Health Use Services, Fidelity, all these big firms run all these different studies that show that if you're a couple at 65 years old, you're likely going to spend $350,000, $400,000 in retirement on healthcare expenses. That's premiums, deductibles, out-of-pocket expenses. They all add up over a long period of time. So I know that number sounds astronomical, but any little bit that you can put aside, and if we're talking about, thinking about everybody's concerned with the deficit, what the government's doing, are taxes going to go higher? I would think at some point they're going to have to. This is a fantastic tool because as you're pulling these funds out, they don't impact your Medicare premiums. They don't impact they're not counted for Social Security taxation. There's so many little things in back pocket taxes, what we call them, that this helps kind of get around. And so if we're looking for an investment vehicle that gives you some tax benefits, this is certainly one. Now, the caveat is you have to be on that high deductible plan. You also, you've been limited what you can put in. So, this year you can put in $4,150 for an individual plan. For a family plan, it's double $8,300. This new Simplify and Expand Health Savings Account Act is going to increase that substantially if this goes through. And I get it. Not everybody's going to be able to max this out, but if you can, this can be a fantastic tool. So what the new legislation is suggesting is that they would like to see it at $10,000 for an individual and $20,000 for a family plan. So that's a pretty significant increase, more than double. And if you can utilize this properly, and now a lot of these plans will also allow you to invest. What we typically recommend on an account like this or suggest is that everybody's different, so no recommendations here. But we would typically suggest keep 2 years of premiums in cash. If they allow you to invest, then you start to invest the additional funds there. And the reason being is that, let's say you get let go from a job, you need to start paying things out of pocket. Life happens. You have these funds that aren't going to be subject to the market fluctuations, where if things are down substantially, you still have these to make those ends meet and utilize them if necessary. And so this can really be a fantastic tool, Lance. Now, the bad thing is you're on the high deductible health plan.
Right.
So let's hope you're in good health, things go well. And that's why I think that we're going to see a bigger push to incentivize this with more broad usage of HSAs.
Right. Well, no, and that's in my opinion, all insurance, in my opinion, should be high deductible. And if it was all high deductible plans, the cost of insurance would come down, because you would start taking people that are on high deductible plans tend to take better care of themselves, because they have to pay all, if you've got a $5,000, I'm picking a number, right? If your high deductible plan is a $5,000, deductible, you go to the doctor and you've got to be sick, right? I mean, if you're going to go to the doctor, it's coming out of your pocket, so you better be pretty sick. Yeah. So people tend to take a little bit better care of themselves. And we've talked about, we talk about the cost of insurance and why insurance is so costly. The Affordable Care Act it was a terrible idea and inflated healthcare prices dramatically for people. But more importantly, if you have high deductible plans, and kind of like car insurance, that, instead of going to the doctor every time you're sick and it's $25 copay, those type of things, that just increases costs for everybody, because somebody's got to pay that $25 deductible, or that $25 copay has to be picked up by all the other payers into the system. So again, if you start moving to high deductible plans, the cost of health insurance across the board would come down for everybody. But this is, to your point, it's, if you plan for this, right, you can lower your personal cost of healthcare insurance down, because high deductible plans cost less because it's coming out of your pocket first. So you can save yourself some money, take care of yourself, exercise, eat right, diet, and do the things necessary, to do that, and the cost of your insurance come down. My wife, and it's interesting because companies are now making a new push, right? So for years, I've been on my wife's healthcare plan at her company, right? So because we're a small company, our costs are higher because we're a small company. She works for a pretty big company, so their costs are lower. It's just function of numbers, right? Yep. So I've been on her plan, plus it eased the cost on our company, because our company have to pay for me.
Thank you.
But this past year, because healthcare is getting so costly for companies, right? So for companies to provide healthcare costs, companies are now making a push that if your spouse has access to healthcare, you can't be on your husband or wife's plan at work. Yeah. So in other words, if both people work and each company offers healthcare, so I had to come off my wife's healthcare and come here. Right, so now my company's having to pay for me, which is okay because I'm in good health and I don't use insurance. But but companies are doing more and more to reduce their cost of benefits, because it is such a large cost to profitability. Wages notwithstanding, right? Wages are one thing. We talk about wages, wage growth, and we talk about that. Well, that's a cost to businesses. But what we don't forget is there's about another 30% on top of a salary. That's benefits, taxes, all the other things. So an employee is very expensive to a business. It's the number one expense. And so companies are looking away to defer as much of that healthcare cost as they can. And so you're going to see more pushes like this towards, shoving more of the healthcare cost onto you. So taking advantage of things like HSAs and things like this is going to help you in the long run.
Yeah, I mean, we can make a lot of arguments when you look at the healthcare system as far as, if you're going to have access to the HSA, and depending if they're going to give you a match, I mean, we oftentimes will advise somebody to go get the match from the 401k. If you're not maxing everything out, which we understand not everybody is, most people aren't, but go get the match in the 401k. Don't leave any money on the table. Then go back, max out the HSA. Then you circle back to the 401k. So there's a lot of ways that you can utilize these to your advantage, because if you put those funds in, let's say the Roth 401k, while we think that's fantastic, you're still paying taxes right now, whereas and you're going to get that tax-free growth. But on that HSA, you're going to put those funds in, you're going to get the deduction on the taxes, you're going to be able to have those funds grow and then take them out without paying taxes later down the road. So
Yep.
you really got to figure this out and understand exactly how the match works on the 401k. Also, if you get one on the HSA, and then utilize that to the best of your ability to get as much in your pocket further down the road.
Yep. All right, quick break. We'll come back just in time. We'll talk about that, what that means, right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valier with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valier. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, back in the 70s, and by the way, there's about as much distance between the 1970s and now as there is between the 1970s and World War II. So, but yeah, back in the 70s, when we were in school, we were taught about the Japanese method of inventory management. It's called just-in-time. And particularly in the early 80s, this became a thing. And, you know, back then when, you know, the vast majority of the country was manufacturing based, we did a lot of manufacturing, we held a lot of inventory. So this idea of just-in-time inventory management was revolutionary to businesses because inventory has a cost. If I'm carrying inventory, it has a cost. And so as, you know, things came about like Federal Express and, you know, a variety of other delivery services and overnight services, and we speeded up the time that we could get things from point A to point B, the need for maintaining all this inventory became much less because I could produce it, ship it, and have it there just in time. And, you know, Japan's a small country, so for them it was easy. The United States, not so much, considering how large we are. So, but over time, over the last several decades, this became a huge boon to corporate profitability, right? Because I could reduce my inventory costs. I held just what I needed to sell to meet immediate demand, and I could order what I needed for upcoming demand and have it just in time for those sales coming in. And this was a huge boon to corporate profitability in the 90s and the early 2000s, and all worked fine and dandy until we shut down the economy. And you could not get anything delivered And so all of a sudden, I had no inventory and I couldn't get anything and caused prices to skyrocket. Well, since then, there's been a lot of concern by companies about another potential shutdown. And so supplies or inventories have remained pretty elevated up to this point. There's been an inventory build since the pandemic over these concerns about not having enough inventory. It's kind of like, people that you don't have food for a while for one reason or the other, and then once you can get access to it, you just hoard a whole bunch of it just in case. And it's kind of the same idea for companies, and they've held a bunch of inventory. If you look at inventory levels right now relative to history, they're at very elevated levels. And now we're going to see companies moving back towards reducing that inventory and moving back towards that just in time, because now they're comfortable that we're not going to have another shutdown, right? We're past all that. We're not going to shut down the economy again. And if I can reduce that inventory, that increases profitability. And so, part of one of the things that we're going to look at, in particular for retailers as we go forward, is the liquidation of that inventory. So either to reduce that inventory build, I either have to sell the inventory I have at lower prices to get it out, right? That's just how I liquidate inventory. Or I have to order less and burn off the inventory. So either one of those create a deflationary issue within the economy. So this will be something interesting to pay attention to. And again, it's not going to be an immediate drawdown. It won't happen tomorrow or next week or next month. Like, we're not going to have a massive inventory sell. But this liquidation of inventories is going to occur over a period of time as companies move back to normality. And this also has an impact for demand as well on the economy, employment, right? Because if I don't have a bunch of demand coming in for new product as inventories are being worked off, I don't need to hire as many people. Right. So there's some ramifications to this that'll be worth paying attention to. And we're seeing this, right? We're seeing this in the Philly Fed. We're seeing this in the Richmond Fed index. We're seeing new orders not really picking up a whole lot. New orders have been declining. Take a look at Philly Fed just recently, Richmond Fed index yesterday. New orders are under pressure, right? People aren't ordering a bunch because they have all this inventory already sitting on their books.
Well, I think there's still a lot of uncertainty. I mean, people are still concerned. I mean, you talk to a lot of businesses and business owners, and they say, listen, our financial forecast isn't as worth what the paper we're putting it on right now, because there's so many things that are occurring. And while I think, albeit people are feeling better, I mean, you look at the market right now about the overall market, I'm not so sure you're beginning to see more and more, news of layoffs, hiring freezes. Does that start to impact people's spending habits? If you look back at this last inflation print, it was a little bit higher than expected. You look at the core inflation. You look at what do they call it now, super core, where you take housing out altogether. I mean, they're coming out with new things.
Pretty soon it'll be super core of super, and it'll be one item.
That's right. Which is what we could do anyways, right?
Exactly.
Break it all down. It's the stuff that we do behind the scenes, kind of looking and trying to get a good understanding as far as, okay, is this transitory? Is this going in which direction? Right. But essentially with that becomes deflationary, right, over time.
Yeah. And again, it's just, this is going to be one of the things that, it's going to be the big debate for this year, is whether or not inflation, deflation, that's still the underlying question, right? Is inflation coming back? Is that why interest rates are going up here lately? Are we going to have stagflation, which is, healthy unemployment and low inflation? I mean, it's just all these different variations of outcomes that people are trying to figure out. Nobody's got a really good handle on it. The question will be ultimately is, what does this mean for Fed policy? Because again, as we've talked about here recently, and we wrote about in yesterday's article that's on the website, we went through yesterday morning, 59% of the survey responses that came in from B of A were either what drives the market in 2024, the Fed, and liquidity, which is driven by the Fed. So, we don't even look at fundamentals anymore. All we care about is what's inflation going to do, so we know what the Fed's going to do. And right now, the Fed is slated, the Fed says they're going to cut rates 3 times. By the way, their meeting is next week, so we're going to hear from them shortly. They could really rain on this whole parade very quickly. But the market's still expecting 5 to 7 rate cuts this year. Probability of the market expectations, 80%, 5 to 7% rate cuts, 5 to 7 rate cuts this year. In other words, they're expecting something worse than a soft landing, but not as bad as a hard landing. 20% chance of 4 rate cuts, which is a soft landing, 0% chance of a hard landing, right? So it just
which means you'll get a hard landing.
which
Thanks, guys.
Which may mean that.
No,
but we'll see. We'll see what happens. But again, there's a big gap between what the market expects and what the Fed says they're going to do.
Yeah, threading that needle is extremely difficult. And I don't envy the position that they're in. But, I mean, if you look at all the things that are continuing, right, you still have some type of QE out there. Mm-hmm. You still have a lot of money sloshing around in different places. And when does that stop? And if it does, or you get into where maybe it's not that soft landing, what happens then? Then what occurs historically, at least what they've done, is inflationary.
Right.
So,
yeah,
that's a tough one. So do they say, okay, we'll keep jobs, but we'll deal with inflation, and we'll have this soft quote unquote landing, softish. But the worse inflation gets, the worse the problem becomes, right? I mean, look at the bank issue we had back in March, April, May of last year. We didn't fix it.
No,
they just put some paper over it, patched it up.
But that's how we do everything, right? We kick the can down the road, we patch it up, paper over it. And that's going to be the question. And again, now we're into this new kind of paradigm, which is for Congress. It's all about just spending money. And so, right now we've got a tremendous amount of federal expenditures that are propping up economic activity. And the question, and now some of that's going to end here soon. But the question is are we about to start passing a whole bunch more bills, either this year or next year or the year after, start passing a whole bunch more spending bills that's going to keep putting, more and more money into the economy.
Well, the new budget bill, certainly just did that.
Yeah. But again, this is what we do with the continuing resolutions. We just mark everything up by 8% and say, there you go. So spend more money.
Yeah, do you spend some time reading in there? It's kind of funny. They count things that weren't necessarily there that could have been there, like COVID relief. Oh, look, there's $6 billion that we're not spending.
Yeah, we need to spend that, right? But see, the problem is if you don't spend, it's like an FSA. Well, if you don't spend it, you lose it.
It is the worst way for accounting ever. We need to incentivize these people to, hey, can you spend below your budget here? And incentivize them that way. Not that, you don't spend it. That's why you get all this frivolous government spending. Because if you don't use it, you lose it. What a terrible way to run a government.
Right. This is why we need Dave for president.
Dave?
Dave. Dave. Yes.
Okay. The movie. Yeah.
Yeah. There was a movie called Dave. And there's basically he's the president is incapacitated. Yeah. And so they find a guy that looks just like the president to come be the president. And he's a little hometown accountant, has a little CPA shop, in a little strip center, just barely making ends meet. So they make him president and they're like, you just sit over there and do nothing, kind of like we have now. And he starts looking at how we spend money. And he says, look, I want to fund this over here. It's like, well, if you can save $600 million, then you can do that. So he starts redlining the budget, right? And it starts being an accountant. It's like all of a sudden he's saving all kinds of money from the government and gets gets things done, makes things better. So maybe we need Dave.
Yeah, I'm gonna have to watch that.
If you've never watched Dave, it's a great movie. It's older, so but it's a good movie. Anyway, with that said, we need Dave. Go by the website, realinvestmentadvice.com. Get your tickets for the upcoming seminar this weekend. Still a few tickets left. Love to see you there. Hotel Sonesta.
Royal Sonesta.
Hotel Royal Sonesta, yes. Correct.
Sorry, there's two. I found out there's two.
There is two, yes. Yeah. It's the Royal Sonesta. Anyway, it's right on 610 Loop. Easy to, easy out. So, it's easy. And then the weather's supposed to be nice, so apparently the rain is going to stop. So we had an event one year. We got completely flooded. So.
Yeah.
Our timing and weather has not been great historically, so this year it looks to be okay. Anyway, get by the website, get your tickets. Got our latest blog post, Michael Leibowitz' new article. Second part of his article on inflation is out today. It's on the website now, realinvestmentadvice.com. Have a great day. See you back here tomorrow with Mike.